Welcome to the Cold Steel Surgical Podcast with your hosts Amir Farouk and Chad Ball. We've had the absolute privilege of chatting with some amazing Canadian as well as international guests over the past year. While the topics have been broad in range, whether clinical, social, or political, our aims for the podcast continue to remain the same. We hope to inspire discussion, creativity, scholarly research, and career development in all Canadian surgeons. We hope you enjoy our second season as we continue to highlight some incredible guests, deliver detailed masterclass sessions on a myriad of clinical topics, and introduce some fresh new features such as debate and companion formats. We hope you relish the podcast as much as we do.
In 1993, the famous hip-hop group, the Wu-Tang Clan, released a song called Cream, which stands for Cash Rules Everything Around Me. While one might quibble with that premise philosophically, learning how to manage your finances is no question an important part of any physician's career. In this episode, we interview Shane DiNapoli, a chartered accountant based in Calgary, Alberta. We talk to him about some of the common mistakes he sees physicians make with their finances, physician corporations, and the financial advice that he has for physicians starting out in their practice. Mr. DiNapoli, thank you so much for joining us on Cold Steel. Can you tell us a bit about your background and where you grew up and your pathway to your current profession and business?
So my background is I'm born and raised in Calgary. I was born the Children's Hospital. But yeah, one place, wherever my mom told me I was born. But I was born here in Calgary. Went to high school here, University of Calgary. Actually graduated from the University of Calgary back in, I'm just trying to read my degree, what's it say, 92. And then after I graduated from the university, I wanted to go into finance, quite frankly. I mean, that was my first choice, but in 92, there weren't any jobs in finance. I think Goldman Sachs hired one person from the University of Calgary, and it wasn't me. So, my second choice was to get my CA back then. And so I ended up articling with a national firm for a few years and had no desire to do tax. Didn't want to, if I'd known I was going to have to work this hard, I think I would have chose to be a teacher or something. So I got my summers off, but it was too late by that point in time. I'd worked at a national accounting firm in public companies, actually. So it was as close to finance as I could have got. And during my time working with these public companies, particularly back then when the Alberta Securities Commission was a little fast and loose and there were a lot of startup oil and gas companies, I got to see some exciting things happen, but companies would come and go. They would start and fail. And I found that environment just a little too distressing and decided to go into tax. And back then, it was a 2-year tax program where, you would get your in-depth tax program without any exams. So it was certainly a certification process, but it was actually quite a nice, easy path, relatively speaking, because I didn't have the stress of exams or some sort of oral process. And through the tax program, ended up finding, my calling, I guess is what I would call it today, which is I found it fascinating. There's nothing more fun than helping somebody that could afford my fee with a problem that I could solve, rather somewhat creatively, or certainly with a number of options available. And, and then from there, it just sort of led to the last 20 years of my practice.
In full disclosure, you and I have known each other for a long time, and you've certainly been a savior for everything financial for me. And I thank you publicly for that as well as privately. But, I'm hoping maybe that we can be super honest here, or at least I can. And it's clear that physicians in general are notoriously poor with the financial world in general. And we can, I think, both throw out many caveats of scenarios that we've seen, friends and colleagues and in your business having done that. How do you sort of frame the financial side of things for a physician, whether it's spending or saving, or how do you approach that? Because I don't think it's intuitive to us, and I certainly don't. I know it's not intuitive when you're starting out your career in medicine.
Well, that's a great question. I mean, certainly in terms of the context of framework, I find it fascinating, right, that, dealing with physicians, and other professionals, that there's this massive investment of time and energy in a career, part of which has, significant financial rewards. So, there's this huge effort. And yet at this exact same time, there's a almost willful blindness to the management of the wealth that comes with it, which is no different than any other life skill that you just find, whether it's a function of the profession or the nature of the person, that the education, right, of the wealth management that, it comes part and parcel with any successful professional, particularly with physicians. It just seems to be, left until after residency is completed, right?
It's totally. I mean, it's completely missing. You might get 1 3-hour session in a 5-year residency and never think or talk about it again. You're totally right.
And I think what's fascinating about that is, and we were just talking about this before we started recording, which is this blind faith, or this conversation where I'll trust a colleague, right? And it's only over the last 20 years where I make this covenant, I guess, with clients, which is, I promise not to practice medicine if you promise not to practice tax, right? Like, let me, explain it to you. Don't take advice from friends. Certainly you can use friends or colleagues as sounding boards. But when it comes to, say, wealth management, everybody's a bit different, and their circumstances are so specific, and the rules now are so nuanced that being educated on that process generally requires talking to a professional. There are very few textbooks today, I think, are well structured for someone that's not already versed in tax. So the best way to become aware, or the best, context for that framework is, why wouldn't you talk to a professional about your wealth management? And at the front of that would be tax. I mean, it's the largest bill any professional will incur in their lifetime. After $200,000 a year, you're in partnership with the government. They're taking half.
It makes me think back to my experience in grad school. And I think I've told you the story before, but I lived with a roommate who was moving through UBC to try and essentially become a trader. And I watched him and lived obviously in close proximity with him for 2 years, 18 hours to 20 hours a day. That's all he slept, ate, and breathed. He had multiple monitors. He was learning his craft. And I remember at that time thinking, oh, yeah, right. It's sort of like me. Like, he's out there learning with the same intensity that I'm trying to learn my craft at. I can never compete with that, nor should I ever try.
Well, I mean, I guess that takes us into the biggest common trend, right, that I'm seeing today is just that, where people are, certainly the next generation, and a lot of residents that I've met over the last couple of years, are astutely aware of that, actually. And they're starting to come and get the advice before they get surprised by either some sort of financial commitment or tax bill. And, and so that trend, that gives me hope, right? That, whatever mentorship's happening, that at least that message is getting through, right? Today, right? Is that, first and foremost, you want a good advisor. You want a few good advisors, quite frankly, right? You want somebody on the on the finance or investing side, on the banking side, on the tax side, and collectively you want a team, right? But that each person will bring something a little bit different to the table. But that if those conversations are being had post residency, you've already missed out on 2 or 3 years. And certainly we've had those conversations while you were doing your fellowship, right? Where, had we not had those conversations, there would have been some surprises, I suspect.
I kind of have a two-parter question for you. And the first is sort of a comment in that, I think part of the reluctance to learn more about the finance side of things is just that you almost feel a bit guilty as a resident or as a newly minted surgeon about making money off of what has been your craft and your art for the last however many years. And so there's almost like a guilt factor associated with that. I wonder if you see do you see any trends like that among surgeons in particular? And are there any differences in the way, let's say, surgeons manage their money versus other physicians?
Well, in one sense, you're talking to the wrong person. There's no such thing as making too much money, as far as I'm concerned. In the sense of, the market dictates. But that absolutely there's an element of I'm making all of this money, but I don't know whether or not I'm managing it responsibly, or whether or not, I should even be asking these questions. And, I think that goes back to certainly the evolution of the career or the progression, where there's very, very little spoken about wealth management during, the early phases of a career, right? I think it's more so. I think it certainly is highlighted with surgeons. I can think of one instance. Would have been years ago, where I had a resident surgeon, and his accounting records consisted of a literal Nike shoebox, and so and part of that, I think, certainly with time or with experience, I've come to realize was. You have a very difficult decision, I think, as most professionals do, which is where do you spend your time, right? So if you can work an additional shift, or you can make, maybe somewhere between, I'm going to make a number up, between $5,000 and $10,000 versus spending a day organizing your finances. Quite often, organizing your finances will take a backseat to that decision. And so from that perspective, I think surgeons certainly top the list in that regards, or more so than perhaps some of the other specialties that I deal with, which is so much, all of your, time and effort is best utilized generating revenue relative to the return on the wealth management. The long-term consequence of that obviously is you may not have a good wealth management strategy, which really can harm you later in your career or later in your life. But that's such a difficult, I think, conflict that does arise, right? Amongst surgeons, but in particular, where it's not at all surprising for me to have a surgeon client who's either late in filing, simply because they've been so busy with work, or they're not able to retain the details that were covered in, say, their year-end meeting, where we've discussed some of these planning considerations, and by the time they've left the office, they've completely forgot because they've gone back to work.
So let me ask you this, and I'm being selfish here as someone who's just starting out my career. What are some of the concrete things that you tell all young physicians or young surgeons when they're starting out that they need to do from a financial health perspective to avoid the problems that you've highlighted? And I'm thinking even when in the lead up to this podcast, I was asking some of my friends who just graduated residency and are out working in community practice, and one of them, Misha Horkoff, asked, what are there any, for example, apps that you'd recommend that physicians use or that you recommend to your clients? So can you give us some concrete tips and tricks for any young physician starting out in their practice?
Yeah, absolutely. So the first thing would be you want to develop a relationship with a professional, with an accountant, a tax filer right away, right? So that'd be the first thing. And you really wanted that person to fit your personality, right? And so, there's zero harm in interviewing two or three accountants. My feelings are never hurt when it's not the right fit, or vice versa. Someone will come and see me after. So that'd be first and foremost, right? The second thing would be is to keep things as simple as possible, right? In the context of managing your finances. So you really want to be able to track or be aware of how much money, what your earnings are, what your expenses are. And the easiest way to do that wouldn't be necessarily be an app, but would be, a strategy that you're personally familiar with. So if you like using Excel, you want to track it on Excel. If you want to just use your bank account to track what your bank account activity is, that's how you would do it. But it would be a matter of, if you don't know how much money you made, you can't necessarily expect anyone else to know. And knowing how much money you make, then from there lead all other answers, right? So if you know how much you've made this year, for example, I'm going to make a number up, $600,000, and you have $200,000 left, well, then you've spent 400. And it doesn't have to be any more complicated than that. You can certainly then go, okay, well, what did I spend the $400,000 on? And you can track that in either, an app, you can do it on an Excel spreadsheet, or you can just keep it as simple as look at your bank statement. And by doing that, you start to become familiar with your own patterns. And so, the difficulty with some of these apps that are out there is they're designed by accountants for accountants. And the problem with that is going to either result in a bunch of data that's not going to make sense to you, or it's going to miscode it and mislead you. So, from that perspective, I think that the simplest approach would be to use your actual bank statement and your credit card activity, right? To sort of have a good snapshot. And it should be done at a minimum monthly, right? Most bills are monthly, and most activities are monthly, in terms of how people will view their budgeting. And so, that'd be the front and center, hands down.
That's such wise, advice. And it's shocking, I think, at least in particular for me as the son of an accountant, in terms of looking around and seeing how rarely that happens with physicians and surgeons, even well into their careers. Like there seems to be confusion when they're honest enough to share it with what's coming in, what's going out, which I guess can happen, but it is interesting. Shane, one of the things that you're well known for, obviously, is professional corporations and how to leverage them and utilize them and construct them. I was wondering if you could, for our surgeon listeners, talk a little bit about that world and how you frame that world, and maybe even what your sense of, in terms of a crystal ball, how is that world going to be changed with our current federal government, do you think, in the future?
Oh, well, let's unpack that. There's a few things in there that I find, I think worth merit. First thing, professional corporations are a relatively new concept in terms of taxation in general. So taxes have been around for over 100 years, at least here in Canada, with corporations and individuals. And it's really only since 1984 that professional corporations have become a thing. So that's not really that long ago in the big scheme of things. And historically, and I would say this is only since, maybe 2005, a professional corporation would have been created for only one of two reasons. Right? Reason number one, deferral. Right? And all I mean by deferral is if you understand the concept of an RSP, then you understand the concept of deferral. You put money away or you hold it in a certain legal entity, and as a result of doing so, you avoid paying tax to one extent or another. And so for an RSP, you just don't pay any tax on the amount you've contributed to the RSP until you withdraw it. With a professional corporation, the same is true, to the extent that you don't pay any tax on having received that income personally. And so at the corporate level, you'd either pay, at least here in Alberta right now, 11% or 25.5%, depending on how much income is earned in the corporation. And so the deferral is the difference between the tax rate paid at the corporate level and the tax avoided that would have been incurred personally, right? So if we assume that you're at the subject to the highest marginal tax rate of 48%, on the first $500,000, presuming there's no impairment in your small business deduction limit, pay 11%. So there's a deferral of 37% from 500 grand. So no small sum, right? And then on the amount in excess of the 500,000 that's retained in the corp, there's a tax rate, an effective tax rate. It's being indexed right now because Alberta's dropping it, but for ease of simplicity, we'll say 25%. And so the difference there between 48 and 25% is 23%. So still no small sum, right? And so by using a professional corporation, and retaining the money in the corporation, right, you can realize this benefit of tax deferral, which theoretically would be realized when you take the money out of the corporation at some later point in time. The other reason to incorporate was to income split. And so that reason survived between 2010 and 2005 or thereabouts, and 2015. And in 2015, 2017, there were some changes to income splitting. And so that reason's gone away. So, unless you're over age 65 or you're no longer practicing, the income splitting benefit is postponed or no longer available. But the deferral benefit stays there. Now, this deferral concept has been around for the last 100 years, right? John A. Macdonald debated this when they introduced the Income Tax Act originally, and they had a different tax rate for corporations and individuals. And the argument was, why should you be able to use a corporation to avoid tax that would otherwise be paid personally? And in response to that, they said, you won't be able to avoid tax indefinitely. You have to pay tax when you take the money out. Now, I'm paraphrasing for the point of not boring everyone to tears, but the idea of this deferral has survived. Now, there's been a number of changes with this current government. They don't like professionals, and they particularly don't seem to like physicians from a taxation perspective. If it feels personal, I think it's because a lot of the legislation has been designed to make the use of professional corporations appear unfavorable. The advantage of these new changes, or I think one of the good things given the complexity of the Income Tax Act, is that it's only the appearance that exists. In fact, professional corporations are more advantageous today than they've ever been, right? And that's the irony of what's happened over these last 3 years, is the federal government has increased the highest marginal tax rate for individuals, and they've reduced the tax rate for corporations. They've made the reason to use a professional corporation greater than ever before, right? Historically, here in Alberta, the highest marginal rate, even just 4 years ago, was 39%. And, by increasing it to 48%, they've increased the benefit of deferral. In the same timeline, they've reduced the tax rate of corporations, at least, in the first 500 of the small business deduction limit. They've reduced that rate by 3%. And so they've actually made the use of professional corporations more advantageous. And so, where do I see that going? I think the government, the federal government historically has wanted to discourage behavior that trends as an erosion to the government's tax base. Now, I'm just guessing. I don't know anybody at finance anymore. And obviously I wouldn't be privy to those conversations, but what they've done is they've created this perception that professional corporations are bad, or investment income in professional corporations is bad. And I think the perception was all they were actually trying to achieve. And so, where I see things going in the future, well, I don't see them blowing up professional corporations anytime soon without having to rethink taxation as a whole, right? And the use of corporations. Now, every time I've made a prediction, I've been wrong. So I don't want to jinx it for every professional like included. But I just don't see them dismantling this structure given all the pushback they had 3 years ago.
You mentioned a little bit in terms of Alberta versus maybe other places. Is there a lot of variability either in concept or in actual numbers when you move from province to province?
No. The utility of the professional corporation survives everywhere in this country. I actually had somebody in Iqaluit. I'm not sure if I'm saying that right. And we had to create a professional corporation that we couldn't find a lawyer to create a professional corporation for Iqaluit because they don't have a Corporations Act. So we had to do it federally, actually. But even there, this deferral structure produced the same benefit.
Oh, that's interesting. Huh. I honestly had no idea. I figured it was quite different from province to province. So that's fascinating. Can you give us your sense of, you said it initially, and you said that, ideally a team when you're starting out would be a financial advisor, a tax expert, with an accounting background and so on. How do you sort of frame, or how do you look at the financial advisor world? Because I also think, that's an area where we struggle significantly. Personally, that I've struggled in that. My sense always in meeting with quote unquote bankers and these financial folks attached to large banks is that they see the world very differently from us, and they without being impolite, are sort of don't have the viewpoint that I really want to be around so much.
I've got some very good friends in finance, actually. And one of the challenges I find with the industry is that the model is based on you leaving the money with them. Like, there isn't an end point. Like, and I find that fascinating, because as an accountant, over my career, like the corporation is just a tool, right? So at some point, its utility will either expire, but it's a function of its utility. Whereas, wealth in general, right? Well, it's your wealth. So when it's with an advisor, the difficulty I find in those instances is the relationship is based on giving them more, and so there's this direct conflict, right, with the advisor of you ended up working for them. Like, so, the one caution I would give every resident, and certainly anyone early in their career, is, and we've had this discussion even before, there's nothing wrong with cash, right, at the beginning. Like, rushing into one of those relationships where putting your money in the market or having it tied up with an investor, well, that's only useful if there's a game plan as to how much you're going to get back, right, on retirement or at some future point in time. And if there isn't that frank conversation, right, it's usually based on the assumption of, oh, well, tell us how much money you want for retirement, and we'll tell you how much money you have to give us now. Well, what if those assumptions aren't actually valid? Why are you agreeing to give somebody, $1 million, $2 million, $3 million of your money today, on the promise that you're never going to get it back, and all you're going to do is get a return, but that return is a function of the market, which the advisor doesn't have any control over, right? And that's a very difficult proposition to, I think, deal with in the context of what are you giving them your money for? Whether you invest in the stock market, you invest in savings, invest in real property. As a tax advisor, right, it doesn't matter what you do with the money in your professional corporation. You can buy lawn gnomes for all I care if they can appreciate. right? And have a collection of lawn gnomes, but it's whether or not you can convert that back into cash at some later point in time. And I don't think those conversations are had often enough, right? As to why you would give the advisor money, and then what is your expectation with getting it back. And I think that's one of the aspects of the industry that I think is a challenge. I think it's a challenge for the client, and then it's a challenge for the industry because clearly they don't make any money if you don't have any money with them. And that raises, that's a very difficult. Everyone I find falls differently on the spectrum on that one.
Well, I think that highlights what you've always taught me and told me, and I've certainly taken it to heart, which is that you probably have to figure yourself out before you can walk into those rooms or those meetings and move forward in a productive way. To your point, are you trying to build some vault of money for when you die, or are you trying to return to zero as you die, or what does that look like? And I think, again, we probably don't do ourselves any service by not sitting down and thinking about that at a deep level intermittently, and then refreshing that thought as well as we go.
And it may also change, and I think that's the other part of it is if it does change, if your needs do change, because it's just in terms of what wealth management looks like. There's two aspects. There's the security, right, which is what happens if you can't work tomorrow. Can you access some money? And then there's the return on your wealth, right? Or the return on capital. And I find that part fascinating because people will end up all over the spectrum of some people believe that their capital has to generate a return. And I don't understand that, right? In the concept of, no, it doesn't, right? The market doesn't have to do anything. You could lose it. And certainly that was not an uncommon thing in the 90s. Right, there were a number. I think that was at the root of what I think MD was trying to do. MD management was to try and ensure that positions don't overextend themselves in ventures and end up with no money.
Yeah, it makes total sense. One of the things you highlight there again is that things change over time in a short or certainly a long career. And one of those things that's common to society in general, but physicians in particular, and I would argue, I think the numbers bear it out, surgeons even more so, is the reality of divorce. How do you frame that event that I'm sure you see a lot with regard to financial stability and financial outlook, and maybe even reverse engineering or splitting, or however that would work for a prof corp?
It's funny. We've every year, fortunately, right, there's one or two divorces come through this office. This year seems to be a particularly busy year. I think there's been, 5 in the last 6 months. The issues always seems to be the same in a divorce in terms of from the accountant's involvement or the conversation, right? And it's a function of two things. One, the division of property, right? So if there's a professional corporation and it has wealth in it, well, half of it is going to be going to a spouse if all of it was accumulated or considered marital property or whatever that number is. So that's part one, right? What does that look like? And part two, and I'll revisit that. And then part two is, what about support, right? So how much income is being earned? And, for all intents and purposes, the professional corporation is just a vehicle by which the professional earns income. So the support payments are really just a function of earnings, and the professional corporation just provides that data to the lawyers to sort out based on whatever case law says X income equals Y support. So that second part is really pretty easy. The professional corporation doesn't change that outcome. On the first part, on the division of property, that's complex. And the reason it's complex is, income in a professional corporation isn't the same as savings in an RSP or equity in the house. So you can't really compare apples and apples. There's apples, oranges, and pears. And where things can get messy, or where I think, clients are best advised, is so long as the value of the professional corporation is properly discounted for the purpose of the divorce, either for the after-tax value, or alternatively, the value of the professional corporation is cut in half, and half of the assets of the corporation are transferred into, the spouse's newly formed corporation. There's more than one way to solve that problem. And I can tell you, all 5 conversations this year have been to use a second corporation to cut the property in half in the PC. And that type of structure or that type of planning requires a qualified, tax advisor and a qualified lawyer, right? It's a area of expertise or specialty that, you either know how to do a butterfly or you don't. And so, if someone is getting divorced or going through a divorce, you would want a divorce lawyer that's familiar with that structure, so that whether or not you go one way or the other, you're so advised, right? And certainly I think that's the biggest challenge, I think, in a divorce today is just that, is having both the lawyer and the accountant advise both parties, hear what your options are. Doesn't matter which one you pick, but you do have options, right? And that each one has a consequence, and it's with today's tax rates at what they're at. I had a conversation with a physician a couple of weeks ago, which was, we discussed the butterfly, cutting the PC in half. And then when they talked to the lawyer, they got sidetracked, said it was too complicated, didn't want to go with it. And I'm like, that's cool, right? But even on the small amount of wealth that we're talking about, not butterflying, your tax consequence is 6 figures, and I could explain that to them. After which the conversation was, well, maybe we should bother with the complication and not pay this, $100,000 in additional tax that could be avoided. And so from a divorce perspective, tax is probably your biggest expense in a divorce if not properly structured.
I think one of the things that I'm taking away from this conversation is just that how important it is to just realize for everybody that these things happen, and paying attention to these things, which maybe aren't the most exciting things. Everyone wants to talk about hand sewn versus stapled anastomoses or some other technical thing in surgery, but these are the kinds of things that'll really potentially make you suffer in the long term. And so I'm curious, just going back to sort of my personal situation, in that I'm new in my career. I'm curious if you have any suggestions specifically for residents. We don't typically think about residents' financial planning because they have a relatively low salary, I guess, from if you compare it to a fully trained physician or surgeon. But I wonder if you have any thoughts or suggestions or advice for residents in terms of financial planning.
Yeah, absolutely. So, the first thought would be this is, as the resident, like, you're responsible, like, only you know how much money you make, and only you know what you want to do with that money, right? Or what, whether you want to spend it, whether you want to save it, whether you want to buy a house, whether you want to just live comfortably, it doesn't really matter. As you figure that out, as you understand what you want to do with the money, then the next conversation would be finding advisors, right? Certainly, financial advisor and tax accountant, is to then tell them what it is that you want to accomplish, right? And that's generally what happens in almost every relationship that I have that's turns out to be successful. The conversation is, well, what do you want to do, right? Like, let's talk about the lay of the land. Let's talk about, do you have a lot of student debt? Do you want to get rid of that quickly? Well, there's ways you can do that. Do you have no debt and you want to buy a big house right away? Or you want to live conservatively? Or you want to travel? Whatever it is, it doesn't really matter what it is, but be clear on what it is that you want to accomplish. And then from there, the right structure follows. The advisor will then tell you how you can do that, how you can accomplish that, or what the consequence of that decision is. And then you can make the decision informed. And the reason that's so important today is after the first $200,000 of earnings, you're in partnership with the government. They're getting half if you do nothing, and you can always do nothing, right? No one has to be tax efficient. It's not an obligation. So, I remember lecturing a couple of years ago at the Docks Lounge at the Foothills, and during the conversation, somebody had asked, rather sheepishly, she said, "Am I being foolish by not incorporating? I haven't incorporated for the last 10 years." And I'm like, "Well, not necessarily. What have you done with the money that you're making?" And her response was, "Well, I've paid off my mortgage." And so from that perspective, that was her goal. She accomplished that goal. There was no inefficiency. There's nothing wrong with that strategy. The certainty is she'll incorporate eventually. Every physician, especially every surgeon that makes anything more than $500,000 a year, will incorporate it in their lifetime. You don't have to do it right away. If your goal is to achieve some other use financially or some other financial outcome, then so long as your structure matches that, then you'll end up with the right plan. But if your goal is to save wealth, right, in the first couple of years, then nothing beats a corporation. But it's being clear on what it is that you want to do with the wealth that you're making. And I think that that's probably the number one shortcoming of any resident that I've talked to in terms of that first year. It's a lot of them haven't even thought at length about, well, what do you want to do with all this money that you're making?
Again, it's really sage advice, and I'm glad I'm talking to you now as opposed to hearing this later. Another question that I got from one of my friends who just started community practice is he wanted to know what are the top reasons why physicians get audited when they submit their accounting at the end of the year, and how can we avoid that?
All right. Okay. Well, that's good. Very good question. There's 4 generally different areas that will trigger an audit. One of them is random. Your number just comes up. In 25 years, I've seen that happen twice, right? So that one's pretty rare, right? So there's the random. Then there's what's called the selective audit, right? So a selective audit would be where CRA perceives an abuse. Certainly for professionals, what they've chosen for selective audits over the last 4 years has been travel, dues and fees, and professional fees. And so what they'll do is, once again, there's nothing you can do to avoid that. Statistically, X percentage of all professionals are going to get a letter in the mail asking for the supporting receipts for, say, their travel for the year. Once again, can't be avoided. And so nothing you can do about that other than keep good records, right? The third one, right, is somebody actually contacts CRA to suggest that you're doing something inappropriate, right? That one's more common in a divorce, right? Or, very uncommon for professionals. It's more common if you're a backyard mechanic or something like that. So there's that one. And then the fourth one is statistical variance. That's the one that you can actually control. And so an example of statistical variance would be meals and entertainment, for example, that exceeds your revenue by more than 5%, right? And so in that instance, it's easy enough to measure, right? Or just an absolute dollar figure, right? Now for, the most common one would be meals and entertainment. Certainly not a problem for this year, but maybe in the past, if you had, say, season tickets to the Calgary Flames, that would be no small sum. And that amount would trigger an audit, right? And certainly has for a couple of my clients where they do have season tickets. There's nothing to be, fearful of in an audit of that nature. In that type of audit, what you would want is records to survive the audit. And so if your goal is to avoid an audit, the consequence of avoiding the audit would be forfeiting expenses that you may be entitled to. And so you can certainly take that perspective, but if you know that you're probably leaving something on the table. A better standard would be to go, what can I do to survive audit? And what you can do to survive audit is to simply keep the appropriate records. And so from that perspective, if it's, you just need evidence that the expense was incurred. So for meals and entertainment, you don't actually need the receipt from Earl's if you go to Earl's. if you have the expense for Earls on your credit card, it's self-evident that you went to a restaurant. Where you are at risk is if you decide to host a function within your department, and you go to Costco and you spend $1,000 on food and alcohol. In that instance, you would want to keep the receipt and then simply be prepared for the audit, right? But statistically, in terms of audit, I would say is a rarity, right? Every professional will be audited maybe once or twice in their career, right, within their professional corporation, but that it'll be a function of these other components, right, such as selective audit, which you don't have any control over.
The last question I wanted to ask you on the way out, if you have any advice or any sort of viewpoint of the concept of insurance, whether that's maybe mortality insurance or whether that's disability insurance, as a financial guru in general, how do you view those two elements?
Well, I mean, so there's different kinds of insurance, certainly that you've touched on, right? So there's the disability insurance, and to the extent that you have disability insurance, I can't imagine anyone that wouldn't. But I do have some clients, physicians that have had to make long-term disability claims, and that it's paid for. It was money well spent. And to the extent that disability insurance is purchased, you have two options. You can do it through the corporation, or you can do it personally. If you do it through the corporation, then any benefits that are received are taxable. And most disability plans pay out at 60% on the presumption that you're not running it through the corporation. And so you bear in mind that if you do run it through the corp, you have to pay tax on the benefit, and there's no one doing that outcome. You can't change your mind at some later point in time. Then there's critical illness, right? And critical illness can be purchased either personally or through the corporation as well. The advantage of purchasing it through the corporation is that the company gets to expense it. The disadvantage is if you do get benefits, then they're taxable, but critical illness is usually a lump sum as a result of some event. And I look at it in the context of it's really like short-term insurance. So, it's better suited for the corporation. Also, if you don't make a claim, lots of critical illness plans will actually refund your premiums. And so, from that perspective, there are a couple of good reasons to run it through the corporation. But once again, it's a personal choice. For life insurance, there's different kinds. For term insurance, for example, you're really just ensuring that there's going to be a payout on death. There's zero benefit to you because you're dead. So it's really about providing for your estate. And from that perspective, then the term insurance is quite useful to the extent that you don't already have enough wealth to self-insure, right? If you've already got $2 or $3 million worth of wealth, then the term insurance is really just enriching your estate after you're gone, and all the power to you, but it's no longer a utility. Right? It's not serving its purpose, at least in my mind. On the other types of plans, such as whole life or I forget what the other one's called. Sometimes the other types of life insurance that have a savings component, I'm not a fan of those plans, and so I'm probably going to offend anyone in the insurance industry by saying that. But I'm not a fan of them on the basis that their key benefit is the tax deferral on the investment income realized in the plan, but that's only useful to the extent that you need to shelter that income. And with the way the tax rules currently exist on investment income on professional corporations, if properly managed, you don't need the deferral. And so from that perspective, they're really selling a product that's going to give you a significant return 15 or 20 years down the road, but that the value of that plan in the short term being less than 10 years is zero, because there's no cash surrender value in the first 10 years of those plans. And I find that those plans are oversold to residents or young professionals that don't actually need it. They don't need to shelter their investment income because they don't have enough to need sheltering. And so, from that perspective, my advice would be, when you are talking to an insurance advisor, is the caveat that you'll make your decision after you've talked to your tax advisor, so that if you do decide to purchase one of these types of policies, it's in alignment with your broader wealth management strategy. And that one, at least that's the out. Throw me under the bus as opposed to trying to battle your way out all by yourself.
You've been listening to Cold Steel, the official podcast of the Canadian Journal of Surgery. If you've liked what you've been listening to, please leave us a review on iTunes. We'd love to hear your comments and feedback, so feel free to email us at podcast.cjs@gmail.com or connect with us on Twitter @CanJSurge. Thanks again.